All right, let's talk more about this now with James McBride from the McBride Group. This has been described, James, as an IPO gold rush. How do you characterize the appetite and the current landscape? And do you see any similarities here to the dot-com bust of 20 years ago?
I sure do. There's the same sort of frenzy, and there's a thing with IPOs called FOMO, which is a fear of missing out. So people are rushing in to gobble up this IPO and some of the other tech IPOs that you talked about. What's a little bit different from the dot-com is IPOs, companies were doing an initial public offering with no earnings whatsoever. There's a lot of revenue, like about $2 billion with Lyft, but they have huge losses. So it's somewhat similar in that there's a frenzy for tech again, but there's a strange thing here where a company with fairly big losses all the time is getting a pretty high valuation.
And I think a lot of people at home are sort of scratching their heads over that. How does a company that has not turned a profit suddenly become valued at $25 billion?
I'll tell you how they sell it. They say, this is just like Amazon. Amazon didn't make any money for the longest period of time. Now it's probably the wealthiest or one of the wealthiest companies in the world. So they're trying to follow that model. And the model that Amazon had was making the market bigger than people anticipated. You know, what's the total available market? It's called TAM. What is that? And Amazon went from selling books to selling everything. Now the question is, how big is the transportation for service market? And Lyft is saying it's bigger than you can imagine, and we're a big part of that.
And we're going to be getting into a lot more cities, a lot more markets. Okay, we clearly saw a big appetite for Lyft today. What do you attribute that to?
Well, again, the frenzy, the fear of missing out, and this real interest in technology. And also this sector, you know, the transportation as a service sector is supposed to be like a $1.2 trillion market. And that includes ride sharing, car sharing, on-demand delivery, things like that. And Lyft controls 40% of the ride sharing market. That's huge.
Yeah, and they had a substantial number of bookings, too. I mean, people are using the service. But, James, with that success comes some risks. So what are some of the risks? As we look at the keys to success here, which are some of the things you just mentioned, there are risks associated with Lyft.
Right. The biggest risk for Lyft is that they're number two. Uber is clearly number one. They're kind of the big dog. They control 60% of the market. Lyft has a limited geography. They're mainly in the United States. They've recently gone into Canada, compared to Uber, which is in something like 58 or 59 countries in over 300 cities. The biggest concern that I would have about Lyft is they're not profitable, and they've never been profitable. They've lost $3 billion since 2012, and last year they lost over $900 million. Their IPO is the largest loss for a company that's ever done an IPO. And then there's other things like their expenses. Sales and marketing, the acquisition of customers is very high. And there's also insurance for their drivers. So how do they lower their costs? The easiest way would be self-driving cars. But the research I did suggests that they might be behind the curve
on that, and so many other companies are looking at that as well.
That's exactly right.
All right, James, an interesting day nonetheless for San Francisco-based Lyft. We'll have to see how this stock does in the days ahead. Thank you so much for coming in.
My
Appreciate
pleasure.
it.